You're watching the 2022 Forager Investor Roadshow.
Welcome to the 2022 Forager Funds Roadshow. I'm Nadine Blaney from Ausbiz, and I'll be your host for today's event. Shortly, we'll be joined by Forager's Chief Investment Officer, Steve Johnson, and then we'll hear from both the International Shares Fund and Australian Shares Fund teams. After that, the team will be joining us for a Q&A session. To submit any questions you may have, please use the Q&A button that's at the bottom of your screen anytime throughout today's event. Today's presentation is general advice only. We have not taken any personal circumstances into account. If you are looking for advice, please speak with a financial advisor. So let's get this roadshow underway. What a tough year it's been for investors, particularly those investing in smaller companies. In Forager's annual performance report, Steve calls it the worst year in Forager's 13-year history. Here he is to explain how the worst year followed the best, why markets have become so volatile, and how Forager is currently investing its portfolios.
Hi, and thanks for joining our 2022 Roadshow. I wanted to start today's presentation with a quote that's almost 20 years old. This is Arnold Vandenberg from Century Asset Management talking to Outstanding Investor Digest way back in April 2004. He said there is absolutely no substitute for paying the right price. In the Bible, it says that love covers a multitude of sins. Well, in the investing field, price covers a multitude of mistakes. For human beings, there is no substitute for love. For investing, there is no substitute for paying the right price. Absolutely none. After a decade of ride your winners and sell your losers, and the right time to sell a great business is never, a lot of investors have learnt this lesson is relevant over the past 12 months, and we have not been immune. It's been the worst year on record for both of Forager's funds. Our International Shares Fund followed up a stellar 2021 with a 2022 financial year that saw the net asset value fall 38% over the year. That was almost 30% worse than the index. Our Australian fund fell 28%, more than 20% worse than the index, also following on from a stellar 2021. If you look at this chart for the Forager International Shares Fund, you can see how extreme things have been. We've had our best year by far in 2021 and our worst year by far in 2022. I remember doing roadshows talking about years of significant outperformance or underperformance, and what's happened over the past 12 months has put all of that in the shade. The same is true in our Australian fund. This fund is now more than 10 years old, and both the worst and the best years on record have been within the past 24 months. Now you're probably sitting there wondering what's happened, and that's what we're here to explain today. Some things we certainly feel like we could have done better, and some things are outside our control. Let's start with the latter. I have never seen momentum in financial markets as strong as it has been in recent years. Markets have always been driven by fear and greed, but I've never seen it on a magnitude like this. As I wrote in my CIO letter to our June quarterly report, I think there are a couple of reasons for this. One is that there is genuine uncertainty about what the future might look like. We've had 20 years of interest rates going down and low inflation. And this might well be the start of a new era of higher rates and more inflation problems, something that generations of investors haven't had to deal with. That is genuine concern. The other factor driving things is that it has never been easier to gamble when it comes to the stock market. We have index funds where you can bet on themes from cryptocurrency to marijuana. We have the rise of Robinhood and other very low-cost brokers that let investors bet on these themes almost 24/7. The number of people actually worried about the underlying value of what they're buying seems to be lower than it has ever been before. And at the moment, all of those people are very pessimistic. These two charts show you how bad the pessimism currently is. On the left-hand side, we've got a chart of US investor sentiment, a measurement called the Bearishness Index. And you can see here we are hitting record highs in terms of investor bearishness about markets. On the right-hand side, consumers are feeling the same. We have the lowest level of consumer confidence in the US that has ever been recorded, Here in Australia, consumer sentiment has recently just headed in the same direction. So there are reasons for people to be pessimistic. Markets, though, have been extreme in their reaction. And the big external factor for us has been that it has been particularly extreme at the smaller end of the market. This is an index that we've put up in our last few years' presentations, splitting out the MSCI World Index into its different components. The top line is MSCI World Value, heavily dominated by energy and commodity stocks. The middle line is the MSCI World Index, and the bottom one is small cap stocks, showing you how much small cap stocks have underperformed the wider market. And the smaller you get, the more extreme it has been. Almost 70% of stocks by number on the NASDAQ and the Russell 2000, that's an index of smaller US companies, have fallen by more than 30%. If you just look at the cohort of the Russell that is less than $500 million in market cap, the average drawdown from peak to the 30 June year end has been 55%. It has been particularly extreme at the small cap end of the market, and that has been true here in Australia as well. The top line here is the All Ordinaries Index, the middle line is the Small Ordinaries Index of smaller companies, and the bottom line is the Small Industrials Index, effectively that Small Ordinaries Index without commodity stocks. You can see that it is down 27% over the last financial year in comparison with a market that is only down 10%. The pain at the smaller end of the market has been extreme, both here in Australia and internationally. Now, I said we have made some missteps. Long-term investors of ours will know that that is the pool that we typically like to fish in. We like buying small cap stocks. We like hunting in areas where there's less research and less competition for those ideas. But we also have very, very broad mandates. We can hold a lot of cash, and we can actually invest in stocks that have absolutely any market cap. And the reason that we have that flexibility is to be able to navigate environments exactly like this better than we have. We should have owned more large cap stocks, and we should have had more cash in both portfolios at 30 June last year. And that was a misstep on our behalf. We are where we are now, though, and the movement in these small cap stocks has been very, very extreme. And I wanted to talk a little bit today about getting back to basics. If the momentum in markets is going to be as extreme as it has been in future, we need to stay even more focused on what we're doing. We're trying to buy businesses here, not trying to predict share prices. And typically, the value of a business changes a lot less than the share price. When we value it, we want that value to grow over time, or we want the company to return cash to us. And what we've seen is that the gyrations in share price around that underlying value of the business has been more extreme than anything we have ever seen. In fact, as we go through the fund presentations later, you'll notice that we have not actually moved the valuations of the underlying stocks much at all across either portfolio. So again, back to basics. How do we find these great ideas? Well, I think there are two really important facets to a good investment idea. The first is that you need to have a differentiated or even a contrarian view, but not just contrarian for the sake of being contrarian. It needs to be contrarian and it needs to be right. There are lots of right theses out there, like, for example, cloud computing is going to be a growing sector for a very long time. We know that, but everyone else knows that as well. It's correct and it's widely known. What you need is a thesis that is different, but that is also right. We're looking for things that are different to what the market thinks. And that little intersection between those two things, something that is differentiated and right, is where the great returns come on the stock market. So what does a differentiated thesis look like? Well, you certainly need to not do what everyone else is doing. This is a quote that I love from Mark Twain. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. And it's exactly what we're looking for, is when the market knows something for sure that just ain't right. And we find that through wide and varied sources of information, using a really broad range of mental models, asking first what might be wrong with the consensus view, and embracing the inevitable uncertainty and unpredictability of the future. JB Hi-Fi is a really good example of something that we are looking at the moment. This is a stock that is quite well known by the market. It put out a really good result a couple of weeks ago. But if you go and look at broker consensus for this business, the assumption about the next 2 years is that its profitability is going to halve. It's going to go right back to 2019 levels. And that's why the stock is trading where it's trading, a low multiple of current year earnings, because everyone thinks it's going to shrink. Now that might be right. We've already talked about inflation and the economy and the problems that the consumer is facing here in Australia. But there's also a thesis here that was once the consensus view that this is a wonderful business that has a very, very low cost of doing business, and that maybe it won't shrink as much as people think, and it may even grow over the long term like it has for most of the past 20 years. I think it's a great example at the moment of the consensus view being one that might potentially be wrong. We don't own the stock, but we're digging and digging to see whether that thesis is right or not. The second aspect to a really good investment idea is not buying from someone that you know more about the business, but buying from someone who is panicking or forced to sell. We call this a dysfunctional market. And to make the most of a dysfunctional market, you need to be prepared. You need to identify businesses with characteristics that you like. Those characteristics might be the consensus view at the time that you find it, but you agree with it and you like it. You need to do your research and value the business, and then you need to wait for the right environment. What does that environment look and feel like? Well, you want to see a lot of forced selling. You want to see market panic, and you want to see sector and business disdain. You yourself are probably going to be feeling very nervous and very uncertain. If you're not feeling that emotion, then it's not a dysfunctional market. You're going to be reading bearish headlines in the paper or online, and you're going to be seeing brokers downgrading their estimates for businesses. Really importantly, there's probably no obvious reasons for things to change in the short term. If it was obvious, the share prices wouldn't be where they are. That's what a dysfunctional environment feels like. And that's what we're seeing in the small cap end of the market at the moment. As we go through today's presentation, you're going to see a collection of pretty exciting, high quality businesses across both portfolios, trading at prices that we frankly think are absurd. We've had this slide up for a number of years in our Roadshow presentations, and it's something that I think we have improved a lot in the business. Yes, we need to find cheap stocks, and yes, we want to run concentrated portfolios of our best ideas. But we also need to put those ideas together in a way that creates a portfolio that has resilience, diversity, and liquidity. We have been actively moving to owning a portion, at least, of better quality businesses across both portfolios. That has not helped us over the past 12 months, but we think it will serve us very well for the next 5 years. We're going to move on to the two fund presentations now, and we'll start with the International Shares Fund. A really quick reminder for newer people to this Roadshow presentation. This is a concentrated portfolio of 20 to 40 stocks. They're our best ideas from around the world. They're typically at the smaller end of the market, but they can also be large cap stocks. We have a cash weighting of up to 30% in the portfolio. And really importantly for us, we have about 1,300 long-term investors in this fund that understand exactly what we're doing. It's key to our success and our ability to invest in dysfunctional markets is having investors that get what we're doing. Gareth joined me when we started this fund way back in 2013, and we've been working on it since its inception. Chloe joined us almost 5 years ago now, in December 2017, and is now a senior analyst. And Harvey McGotti joined us 3 years ago, and is now portfolio manager alongside Gareth of the fund. Despite what's happened over the past 12 months, this fund has actually outperformed the index over those past 3 years. And with that, I'll hand you over to Harvey and Gareth.
Thanks, Steve. A year ago, we presented this same slide for the year ended June 2021. That slide showed a couple of really big winners and a long tail of stocks that had meaningfully contributed to portfolio returns, with 24 different investments providing more than 2% of fund returns. Importantly, there was no meaningful losers. Unfortunately, in 2022, we're reporting what is a mirror reverse. We have lost money on a long list of stocks, and we've had no meaningful winners. Steve talked about the pain in the small cap area. This is historically the space where we've been able to find the most mispriced investments, but nothing worked in 2022. Unfortunately, that was the area where we lost the most money, but we also made some missteps on larger cap investments as well, like Meta. The contrast between 2021 and 2022 is even more stark when we look at the individual stock returns.
Some of our biggest contributors in 2021 were also our biggest detractors in 2022. We had reduced our weighting significantly in a number of these names as they rallied through the last year, but nowhere near as much as we would have loved to have done in retrospect. We'll touch upon some of this later, but the valuation compression across these various names has been much more significant than what the overall market experienced. Many now trade at significant discounts to the broader index. Although we had sold down some of our holdings in names such as OpenLending and Zebra, we kept sensible weightings in them as we really like the business over the long term, and we've used the recent pullback to add to the positions. OpenLending is a fintech business that provides a platform to auto lenders, including risk-based pricing and analytics. It primarily focuses on the US near-prime credit score market. In other words, people with a reasonably solid credit history that don't quite make the cut into the sought-after prime category that commands much lower interest rates for consumers. We feel that the market is underestimating the business quality and long-term growth prospects here. Margins have been very resilient, and the business has grown over the past year despite an extremely tough environment given the shortage of new and used cars in the United States. Despite this, the multiple has compressed from 24 times to 10 times earnings over the past 6 months. Zebra Technologies, some of you may be familiar with. It's a mobile computing and analysis firm that helps customers track and analyze their inventories and products in real time. You would have come across their various products in your everyday lives, from staff using their scanners at Woolworths to your postal deliveries containing barcodes and tracking chips made by the company. We originally bought this business a few years ago when we felt the market was mispricing it. This has happened once again, and we almost doubled our weighting in it over recent months. The long-term beat and race history is good evidence of a high-quality business and a great management team. There still seems to be a perception in the market that this is a hardware company. This is not true. There's been a transition towards software and analytics solutions, and this has made the business much more sticky from a customer viewpoint.
Flutter is a relatively recent addition to the portfolio. This is a global giant in online sports betting and gaming. You may be familiar with the Sportsbet brand here in Australia. Flutter also owns the market-leading brands in the UK and the US. Our most important variant perception in this stock is that online sports betting is a winner-take-most business. The market leader takes the lion's share of the economics. Now we can see, looking in the US, that Flutter's brand, FanDuel, is the market leader in most states and is actually picking up share. We think that the market isn't giving it enough premium versus competitors like DraftKings. Another point of differentiation here is our view around gambling regulation changes in the UK. There's some big changes coming, but it's not yet been told to the market what those changes will be. Flutter's taken a very proactive approach here by focusing growth on retail bettors rather than large bettors, and also introducing a lot of safer gambling tools. A lot of its competitors have taken a wait and see approach. So Flutter's kind of fighting with one hand tied behind its back. And we're actually looking forward to the proper announcements around these changes and a more level playing field. Lastly, we think Flutter's being punished for being a multi-country operation listed in Europe. Most investors, particularly American investors, would rather invest in a pure play US business. But what we think that misses is that Flutter's leading in America because of the operational excellence and know-how it's developed over decades in markets outside the US. We love the story. It hasn't stopped it from falling in price like everything else. We've been adding to our position more recently. It's certainly not the only stock to derate over the last few months.
As you can see on this slide, valuation multiple compression across our portfolio has been extreme, ranging from 20 to 60%. The small cap end of the spectrum has been particularly brutal, and stocks have derated much more than the broader markets. Most of these businesses continue to be resilient, and we are very positive about their long-term value. In fact, on the right-hand side, you can see their current respective growth rates, which average very high levels. We think the portfolio is set up for a good coming few years. So what are some of our best prospects for 2023? we can talk about 3 buckets today. The first one is quality compounders. These are names that you may be familiar with. We spoke about Zebra just now, but others such as Keysight, Meta, and so forth. Great businesses that have derated a significant amount where we think the long-term growth prospects are significant. The other bucket is small cap growth. This is a part of the market that's been significantly hit over the past 12 months. Valuation multiples have compressed, as you saw in the previous slides, and yet many of the underlying businesses continue to do well. We're very excited about names such as Celsius being back in the portfolio, and others such as Cryoport or Blanco that screen much more attractive than they have in the past few years. And finally, Gareth already touched upon Flutter, but we remain excited about US gambling legalization, and we think that the next 12 to 18 months are going to be very exciting for the group, and in particular, Flutter.
We'd like to end with a few key points around current portfolio positioning. As you can see on this slide from our top 10 holdings, this is not an index fund. We own a diverse group of businesses by sector and by geography. They've all been highly correlated like everything else. The past 6 months in particular, everything's fallen. But these businesses are very different and will behave very differently over the medium and longer term. Secondly, we've been culling the longer tail of smaller investments from the fund. And we've been prepared to get more and more concentrated as more information comes in and our convictions wax and wane. It's important for investors to understand we are prepared to own a more concentrated portfolio than what you see on this screen today, if we feel we're getting adequately compensated in terms of potential return. Thirdly, secular growth companies are important to this portfolio's future. While they've hurt us in 2022, a lot of these businesses have 5 or 10 years of rapid business growth ahead of them. What's different today versus 12 months ago is that they're available at really reasonable prices. Lastly, it's a volatile market and we've experienced a lot of pain over the past 12 months. But the opportunity in front of us is as good as we've seen in a long, long time. This is the kind of market where we can find stocks that can meaningfully outperform over the next 5 to 10 years. Thanks, Steve. Back to you.
Thank you, Harvey and Gareth. We'll move on now to our Australian fund, which is listed on the stock exchange under the ticker FOR. We've been intentionally moving this fund over the past few years to some better quality businesses, and you're going to hear about those today. Once again, that has not helped in the short term, but we think we own a wonderful collection of businesses here that are going to perform well over the coming 5 and 10 years. Alex Chevalev's been working on this fund with me since July 2017, and he was joined by Gaston Amoros in November 2020. And here are Alex and Gaston to take you through the current portfolio and positioning.
Thanks, Steve. So the stock price declines that we've seen across the portfolio over the last 12 months have been quite broad-based. They've been across different sectors and across different business models. The 3 of the largest positive contributors, well, they were sold mostly earlier in the year, and they accounted for about 1.6% positive contribution. The negative 3, they're about 9.4%. Now, as you would have heard from our international colleagues, larger stocks outperformed smaller stocks by quite a margin, and especially relevant in the Australian context, resource stocks outperformed industrial companies, such that industrial company price to earnings multiples in Australia actually contracted about 25% during the year. Now, by far the largest groups of stocks that caused the damage last year was the enterprise software companies. We increased our weightings in these as stock prices fell, and we took the opportunity to add to new positions at share prices dramatically below prior peaks. Now, we were clearly too early as these continued to fall into the end of the financial year. Some of these investments are in businesses that are currently loss-making, and you might be asking why a value-biased fund manager is investing in companies that are loss-making. Well, we've actually had quite a bit of success in this space over the last 10 years of the existence of the fund. Jumbo a couple of years back was a great example, RPM a good, more recent example. These companies are frequently misunderstood, and it's exactly because of that short-term lack of profitability that the companies can sometimes build up significant long-term value. Now, these businesses, they have quite a lot of interesting and positive characteristics, and I'll hand over to Gaston now to talk through some of them.
That's right, Chev. We like these businesses, these companies quite a lot, and there are many good reasons to do so. Just to name a few of them, these are proven business models. They are not concept companies. That means these are companies with a proven product that solve real customer needs and that already generate a decent and growing amount of revenue. Just to give you an example, Whisper already caters to some very large customers, and it's clearly addressing a need to manage communications with customers and employees more efficiently and effectively. Also, these companies are part of a large and growing market. That means we don't have to worry about a stagnant or shrinking market or market share battles. Our companies are growing with their markets. In some cases, they're even taking share in these markets. Think about Nitro, the PDF productivity and e-signing company. They already operate in a $10 billion global category, and they're about to move into another one, e-signing, which is twice as big. They're also, all these companies are also highly scalable. What that means is that the marginal cost of production of one incremental unit of software is actually very low, typically zero. What that means is for each incremental dollar of sales, you get a lot of margin, a lot of profits. Mining software company RPM Global has an incremental EBITDA margin of over 60% over the next 3 years by our calculations.
There's also a lot of recurring revenue in these businesses. Now, customers tend to stay very sticky to these products. They're often mission critical and they're very difficult to rip out and replace with competitor products. So a company like Big Tin Can, for example, the sales enablement business, they have the vast majority of their customers from the prior year stay with them. That means that the Big Tin Can and a lot of the other companies in this list, they can focus on selling more software, more modules to their existing customers, and also focusing on new customers, thereby increasing the revenue growth of the businesses. We also believe these companies are very well managed. The CEOs are very well incentivized with holdings of equity in their respective companies, millions and millions of dollars worth, and a lot of them are actually founders of these businesses as well. Now let's change tack a little bit and talk about the domestic economic environment, which has clearly deteriorated. So inflation is significantly above the RBA comfort zone, and interest rate expectations have gone up in line with that. Now, inflation has been significant across food, across fuel, rent, and a lot of other essential items, and that is feeding through to lower disposable incomes for families. Rising interest rates, especially on mortgages, well, we're partially through that, but there is still quite a lot more to go there. The market estimate at the moment is in 12 months for mortgage rates to be about 5 to 6%. And that will mean that about 40% of mortgagees will be paying more than 40% repayment higher on their mortgages. So it's no wonder really that consumers are feeling downbeat. But the market moves in a lot of stocks that are exposed to the domestic environment. They've been significant and in a lot of places overdone. Now, one example of this is Motorcycle Holdings, the motorcycle retailer. The company's taken advantage of a strong COVID period by reducing the debt on its balance sheet, by making a handful of acquisitions, generally improving the business. It started trading the year at about 10 times earnings and actually derated quite sharply to 6 times by the end of the financial year.
That's right, Chev. Another very good example is 7 West Media, the TV channel. If you look back in December, the company was trading at 6 or 7 times earnings. Since then, they delivered 2 earnings upgrades, and yet the stock closed its fiscal year in June trading at around 4 times earnings. And this is because the market is getting increasingly more concerned about the health of the advertising cycle in Australia.
Viva Group, the gyms operator, it's another really good example of this. They had a very poor COVID as gyms were locked down, but is now starting to come out of it and is beating their own expectations around revenue returning and around margins. But this post-lockdown winner was also hit quite hard over the last 6 months, derating from about an 18 times PE to 8 times.
Another good case in point is Media, the out-of-home advertising company that forms a duopoly in Australia with JCDecaux. If you look at their share price, it's down 30% from December to June, and that's with earnings forecasts that are basically unchanged. Again, so that represents a compression in the earnings multiple from 17 times back in December to 11 times now. And again, this is a reflection of a creeping worries about the outlook for advertising. As you can see with these four companies, they are all exposed to deteriorating economic conditions, but the share prices are already discounting an overly harsh environment that may or may not happen in the future. Now, as we look forward to the next fiscal year, here's a few themes, interesting themes that we have running across our portfolio and that we think will generate interesting returns for us for the years to come. Software we already talked about, whether mature or high growth software, so we'll just say here that A, these stocks are down quite a lot, and B, these are great business models that, of course, they need to continue proving themselves in terms of their ability to deliver revenues and incremental profits, but the outlook looks very promising. We also have sector like tourism that we have spoken about in the past. Here we own some companies that will benefit from an increase in inbound tourism after 2 years of closed borders and lockdowns, such is the case of RV operator Tourism Holdings, having 2/3 of their fleet in Australia and New Zealand. Perhaps a surprising inclusion in here is healthcare. Here we own some very defensive businesses that are currently being disrupted by the combination of Omicron waves, a strong flu season, staffing issues, all of which are compressing margins temporarily. Now, we think the market is capitalizing too much negativity in the current share prices for businesses that have fundamentally a healthy long-term outlook. Integral Diagnostics, one of the largest radiology companies in Australia, would be a good example of that. Finally, we own some companies in mining services, companies like McMahon, that are trading at severely discounted valuations as the market assumes that the staffing issues of the last year or so will last for a very long time. Again, we think that we are at the point where these companies can start passing through higher labor costs to customers, and therefore we remain optimistic about the outlook for the sector.
Thanks, Gas. So throughout the last year, we've taken the opportunity to increase weightings in stocks where we have more confidence of their risk-reward outcomes. We also now have more of a portfolio in businesses that are growing, where higher quality business models are more the norm. Now, it's the likes of the enterprise software companies that we've spoken about and others across the portfolio. Especially earlier in the year, we kept more larger, more resilient and more liquid businesses in the portfolio. And having those investments earlier has allowed us to be able to now take that weighting and distribute it to companies where we feel there is greater potential upside. And as you can imagine, with the market environment that we've just described, the opportunity set for new ideas is very prospective. Now, we've talked a little bit about this over past webinars, but the traded price of the Forager Australian Shares Fund had been at a discount to its net tangible assets over time. You can see on this slide that has come way back over the last little while. And it's been a combination of a distribution policy that we put in place some months back, alongside a buyback that has driven that discount back to less than 5%. Now, Steve, back to you.
Thank you, Alex and Gaston. I hope that has given you a good understanding of what has happened over the past year and how attractive both portfolios look today. It has clearly been a disappointing 12 months, especially so for those of you who invested with us more recently. I do feel your pain. And as we have said today, we could have navigated the past year better. But you don't get wonderful bargains without dysfunctional markets. Previous sell-offs have been great investing opportunities, and we have rarely been more excited about the prospects for future returns in both portfolios, and that's looming recession or not. I have no idea whether wider markets recover or not in the short term. As I said at the start, I have never seen waves of momentum this strong. But they will recover at some point and most likely overshoot on the upside. In the meantime, our businesses can keep growing their value or returning us cash. Thank you for your continued support. I thought things were too pessimistic back in February already and made an additional investment in our international fund. My confidence is only higher given the lower prices today, though, and I look forward to showing what a great opportunity this was over the coming years.
We're coming on. Thank you, Steve, and thank you for watching at home. And that is exactly where we are handing it over to you, the viewers, for any questions you may have for the team. I'm joined by Steve Johnson, of course, as well as Chloe Stokes. She's International Shares Fund Senior Analyst, and Alex Chevalev from the Australian Shares Fund. He's a Senior Analyst there as well. Welcome, all of you, to the studios. Thanks again. Look, Chloe, you've talked a lot about price momentum and market noise today. If we talk about fundamentals and from a fundamental perspective, what stocks have disappointed you and what have you learned?
The first theme that comes to mind there is cost inflation, and a couple of good examples on the International Fund are Pinterest and Twitter, some of our social media stocks. What we've seen with them is that revenue growth has been ticking along quite nicely, but we've significantly underestimated some of the cost inflation. And especially in these kind of technology businesses where the staff are quite highly skilled and it's a tight labour market, when those revenues grow, a lot of the benefits tend to accrue towards staff more than shareholders, and we need to remember to factor that in.
I mean, a good example on the Australian fund is AMA, the panel beating company. You've got inflation there coming from the labour side, a little bit different to what Chloe was suggesting, but still coming through quite strongly, and on the parts side as well. That's been a big disappointment of the last year. And the main thing there was that it was actually difficult to pass all of that inflation through to the end consumer because you had agreements that were reasonably fixed.
Mm-hmm. Okay, well, I have you, Alex. We have seen a significant bounce in small cap shares already, this financial year so far. So what has that done to portfolio allocation or enthusiasm towards certain, themes or stocks in particular?
I mean, it's been good to see. I think you would have seen Steve through the presentation talk about it's difficult to pick up the bottom there. We were investing with high forward returns that we thought on the portfolio, so it was good to see that occur during the month of July. Some of that June underperformance and some of the June absolute negative performance of the index and the fund was a lot of tax loss selling in some of the smaller companies. We saw some of that reverse in July, and generally slightly less pessimistic tone gave a very strong bounce.
Didn't quite see that same June tax loss selling impact because obviously the US investors have a December year end rather than June year end, so it hasn't been as violent, either the June moves or the July moves in the international fund, but some similar themes, I think, around small cap stocks. There are quite a few things in there that with inflation and interest rate expectations muting somewhat, that we've seen a pretty big bounce in some of that growthier end of the small cap market.
Okay, Mark has written in, thank you, Mark, saying, are those forward PE ratios being discussed in the Australian fund segment reflecting lower multiples or simply lower expected earnings at the same multiple?
So Mark's right, that's a great question. What is happening there is we've got the anticipation of lower earnings in part from people actually trading the stocks. The numbers we've put on those slides are forward consensus numbers, which in this case have probably trailed what the earnings are likely to be at that point in time. So there will be a reduction most likely in some of those earnings expectations. But the points that we're making around some of those stocks is that the actual prices now are more than encapsulating that reduction
in earnings 1-2 years out.
And we've had a good example of that in the international fund as well. We own this little Israeli business called InMode. They produce aesthetic solutions. So think kind of a step above fillers and Botox and below plastic surgery. So that stock has been down really significantly, but they announced their results in the last couple of weeks. They raised guidance, though only by a little bit. So they've kind of just beat expectations, and the stock is up 30 or 40% in the last couple of weeks.
Yeah, I think there's two things. One is trying to find businesses where that expectation of declining earnings, that's exactly what's happened, is the market is saying those earnings are not going to arise. You know, Seven West Media is not trading at 4 times earnings because people think that those earnings are going to stay there. It's because they think they're going to decline. So Chloe's touched on an example there of a business where we think that pessimism is undue. The other thing is we're trying to value businesses here over the lifetime of what they're going to make. So it's just looking through whatever that next 12 months might be, which we probably don't have that stronger view than anyone else about how bad it's going to be. In my mind, there's a lot of uncertainty about what type of recession it's going to be. Even if it is going to be one, it might be a relatively full employment recession, which would be something different from what we've ever seen before. But the easier thing is looking 5 and 10 years down the track, and we're really focused on the sustainable underlying earnings of these businesses, and whether they're down 20% next year or not, it's not really the main valuation input for us, or certainly doesn't justify share prices halving over the past 12 months.
John asks, what is the price to earnings for Forager and the Forager International Share Funds?
We've put it out there when we did the recent roadshow for FISF that it was about 13 times earnings then. It might be 14 times earnings now. It's a bit easier in that portfolio because we don't have that same skew towards some of the smaller, less profitable business. So maybe, Alex, you can touch on what that might mean on the Australian fund context.
Yeah, I mean, there is a minority of that portfolio in the Australian fund, call it 20 to 30%, where the businesses are either loss-making, and we spoke in the presentation about some of those in the enterprise software space, or which are ticking over that marker, which is also an interesting place, but that would give them a high visual PE if you were just to look at it. Again, to Steve's point, we're looking at these businesses over the long term and evaluating that stream of cash flows back to today.
Another question, I don't have a name for this one, but we will forgive you for that. It's a good question. Was there any thought to transition, I'll ask you this, Steve, into more value-based companies, for example, oil, gas, European banks earlier? Is it too late now? This person says the portfolios seem very tech-heavy for a value manager.
Yeah, so I think that they're both the same question. Hopefully from today's presentation, you've seen we still do own some very, very low multiple traditional value stocks, and I am still very keen to balance the portfolios so that it is not simply one factor, that we have a good balance of businesses in the portfolio. We've talked about it today. I mean, we bought Lloyd's, we bought Tesco in our international fund, we bought some oil and gas stocks. Our mistake was clearly not doing anywhere near enough of that. I would say 3 months ago when we did the International Fund Roadshow, we talked again about commodities and some of the long-term themes at play there, but that it was probably a bit overdone at that point in time. It's interesting again now, you know, oil price back to 90, share price is down quite a long way. I think it is an interesting time to start thinking about that. I think rather than deep value, the way to think about us is frequently looking at and doing what is anti-consensus at the time. So at 30 June last year, when the tech sector has been absolutely smashed, you should expect us to have a big allocation and weighting to those types of stocks. We think we can value that growth exactly the same way as we value a business that's not growing that rapidly. Alex touched on in the presentation, we were clearly too early in terms of going into some of those businesses, and I think us being more disciplined around we are going to wait for the real panic here is part of the improvement to what we want to do. But you should expect us to be in unloved and underappreciated sectors rather than a specific type of business.
Got it. All right, Adrian has asked, fair question, after reflecting on these years of dramatic over and then underperformance, what, if any, changes have been made to the investment process? I mean, you just touched upon sort of a change in thinking about panic stations at markets, but what else, Steve?
Well, there is a bit of that previous answer in this question as well. I think more disciplined, even more disciplined. I don't know that we're ever going to see a year like 2021 again, just in terms of the magnitude of what happened in both of our portfolios. it is not normal that you need to sell your whole portfolio because it has just gone up so much. And we actually, our turnover was 100% in the international fund. We have never ever done that before. It's typically about 30%. So we were selling lots of things. I think to say we should have been even more extreme is true. Yeah, it's bizarre, but it is true that we should have made an even more aggressive move. So I think part of my role as CEO is being more disciplined, having a bit more perspective about that stuff, that, okay, we're seeing what's going on here. This is overly optimistic in terms of the market spirits at the moment. We need to hold more cash. We need to be much more defensive in terms of our portfolios, and me having a clearer role, I think, as CIO around how we do that is part of the improvement. And it's really, really important not to overreact at the wrong time. You know, we saw that at the value end of the spectrum. People were winding up funds and getting out of that sector at the absolute worst possible time to be doing it, and saying we're never going to buy value stocks again. And they've been the ones in our Australian fund that have done sensationally well over the past 2 or 3 years. So we don't want to overreact to what's happened to the past 12 months, but I think there are some tweaks and some changes. Chloe, you and I were talking about this earlier. I mean, in terms of your own, how we handle it next time, how are you feeling about that?
We're thinking a lot about just building up a bench of high quality businesses that we like the cash flow, the revenue growth and the management team, and they might not be trading at attractive prices right now, but often you will get a chance and you won't have much time to take advantage of that. So we're really focused on building a deep bench of stocks that bring the things that you were talking about to the portfolio, Steve. So diversification, resilience and liquidity. And we're kind of coupling that with the more opportunistic purchases when we have an edge and we know something the market doesn't, or when we're looking at just widespread market dysfunction.
Okay, let's move on from that one. So again, from the nameless person or persons, if no company dividends or a capital loss, how does the Aussie fund pay the 4% yield? Will there be forced selling or borrowing just to pay that yield?
Look, that's a really important question.
Yeah.
We were really clear when we came out with the distribution policy for the fund here that this is a capital appreciation vehicle, and your returns over the long term are going to come from the returns that our underlying portfolio makes, and they're typically not large dividend payers, although some of them can be, and in the right market environment, dividend paying stocks might be where the cheapness is. So that can wax and wane. Do not think of this as an income investment just because we are paying yield. What we're trying to do is create more predictability around that. So in years where we have really big returns, you're going to get less than that distributed. In years where the returns are not so good, you're going to get more than it distributed. It's not difficult for us to manage in terms of the cash levels. We've typically got more than, we're targeting a 4% distribution here. That's 2% every half. That sort of liquidity is very easy for us to raise in the portfolio. So it's not going to be a source of forced selling or anything like that, but I do think it's really important. We're just trying to improve the listed nature of the product here. It's traded on the stock exchange. We've seen that the discount and the premium can come and go, and historically people have been completely dependent on that market price for their return from this vehicle. So if it happens to be trading at a premium or a discount when you need your money, can dramatically impact your returns. Doing the buyback is aimed to keep the unit price closer to its net asset value, and then adding this distribution policy is just saying to people, you can get 4% of your investment here at least in cash every year, and that is another mechanism that's outside you needing to sell your units on market to realise your proceeds.
Okay, why is the team so confident of the software as a service, SaaS companies and tech? Is Forager late to the party and now just doesn't want to sell out? Like if rates continue to rise, what are the chances of another 50% fall in these companies? Again, I think you sort of touched upon it insofar as you don't have a crystal ball as to exactly what type of recession this is going to be, if we have recession, etc. Do you have underlying confidence in SaaS companies and tech? Or are you sort of agnostic when you look at them? It's more of a company specific.
Yeah, I mean, you saw some of this in the slide that Gaston and I talked through before. There are some really interesting business model characteristics to these companies. And we had seen for a number of years a lot of enthusiasm about that space. And we now see a lot less enthusiasm about it, despite the last month or so of a bounce. Now, the part about inflation is an interesting one as well, because a lot of these businesses, they're quite well ingrained into their customers, and that means that they can increase prices. They can pass along the inflation that they're seeing, mostly staff inflation, into the price of their products reasonably easily, and that is difficult for some other businesses to do. So in an inflationary environment, you should be able to increase your product prices as well to cater for your inflation and sometimes over cater.
There's a company in the US called Upland Software that runs around buying subscale software as a service businesses. So they're typically owned by venture capital funds that were trying to grow it to $1 billion, got to 100 million of revenue, and they've said this is not going to be our $1 billion stock business, so we want to get rid of it. And these guys buy that business, and they very, very consistently and repeatedly take them from not making any money to making 30% margins by just turning off the growth taps. And we've got a nice revenue stream here. It comes in every month. Let's just stop spending all this money on marketing, product development even. They still spend something on it, but in terms of trying to capture this massive TAM, they just turn it off and they buy these businesses at 3 times revenue, get them to 30% margins and make lots of money doing that over and over again. There is very little doubt in my mind that the businesses that we own here, we might be wrong about how big they can get, how much they can grow. That's the upside here, is that they keep growing at 25 or 30% per annum. But you could turn the taps off tomorrow and have a very, very nice business where the customers are stuck's the wrong word, they're using the product, the switching cost is very high, so they're not going to move to something else, and you just sit there and collect revenue off them for a very, very long period of time. They are building, in the old days you had to build a factory in order to produce the product that you wanted to sell. That went onto the balance sheet. All of these companies are expensing all of that customer acquisition cost up front. You don't see it as an asset, but it is a massive asset that's going to generate revenue. So we've got a really mixed bag of businesses here in terms of who the end customers are, but that business model is one that is proven time and time and time again, and we've owned a number of them over the years and done very well out of them.
Just on that point as well, I think you've seen a curtailing of some of the enthusiastic spend that these businesses were making just over the last 3 to 6 months as the environment here has changed. So you actually have operating cost bases that are staying flat or growing very slightly, but you still have revenue that's growing 15, 20, 25%. And that brings these businesses much closer to break even and into break even over the next 18 odd months.
And just on that interest rate question as well, it may drive the enthusiasm for the sector in the short term. We may see a lot of noise around it. The share prices can fall further, there's no doubt about that. In terms of our valuations of the businesses, we're using quite high discount rates already. Whether interest rates are 3% or 5%, I don't think it's going to change dramatically the opportunity that's on offer here.
Okay. Back to distributions from Mark saying, is there a distribution coming for the international fund?
We had a couple of admin questions here. Firstly, on distributions, no. We had a horrible year, as people can see. The distributions from that fund are 100% of the taxable income for the fund for the year. We will try and align that roughly with performance, although we try generally not to realise more gains than we need to in any one financial year. So not only was it 0 last year, but you should probably expect low distributions while we have so much unrealised losses in the portfolio. There was a question about July performance as well that I just wanted to correct, saying the Aussie fund was up a lot and small caps are up a lot, but the international fund was down. That's not actually correct. The numbers might not have been updated on the website yet, but the fund was up 4.5% or something for July. Again, I would encourage people to focus on the long term here rather than any 1 month's price movements though.
Got it. Can you please advise when you communicate with CEOs, are their views there matching up with consumer confidence that you showed in the graph there? So I suppose just looking for insights that you're getting from the conversations that you're having. Alex?
Sure. So I think there's been a really interesting divide with some CEOs. They look at their businesses and they see the last 6 months, and maybe they have some idea of what's coming down the pipe, but a lot of the visibility is perhaps less than it was, and less than the current movement in the situation probably suggests. So we still have people coming out, being quite bullish, quite optimistic about the last 6 months, quite optimistic maybe even about the month or two ahead that they can see. It's going to be interesting to see what that commentary looks like come AGM season and then later in the year as well and into February next year.
Well, I've got you here, Alex, the Apollo merger with, what was it, the Leisure Group, I think it was called? Tourism Holdings, yeah. Might be stopped due to competition issues. This is from a viewer. Does this matter?
It matters, I think. So both of those businesses stand alone. We see a lot of upside together, they are a group that we see potentially more upside in again. They still have to go through the consumer on both sides of the Tasman approvals. There was some announcements by the companies around what sort of divestiture they may need to make or want to make in order to push that through the process. So we're awaiting more details on that. But an exciting opportunity either way, either individually or together.
Okay.
I just had one really quick point to add on the consumer confidence side of things.
Okay.
One of the really weird things, I actually read a stat on this the other day. They asked people, how do you think the economy's going? And everyone is saying terrible. That's what you're seeing on those charts at the moment. Ask people what their own personal circumstances are like, and everyone's saying, oh, it's fine and really good. And a lot of CEOs that I'm talking to are saying, everyone's telling us they feel terrible, but they're still spending money. And that's true here in Australia, and it's true in the US. And again, I think they're getting squeezed. They're running out of savings here, but their balance sheets are still very healthy, and they still have their jobs. So at the moment, we're still seeing people spend money. And that is all everyone has, is the visibility over what's happening at the moment.
Yeah, and that's the extraordinary thing about this phase that we're in right now. One of the dynamics that are quite unusual. Sorry to cut you off there as well, Steve. So, question coming from Greg, saying, on the subject of building a bench of high-quality businesses, you have spoken favorably about Alphabet. The Google parent company is a wonderful company on several occasions. Is there any long-term intention to include this company in the international fund? Chloe?
That's definitely one of the stocks that is sitting on our bench list. We have a look at it every time it reports a result. We talk about it at our meetings all the time. So it's definitely on our bench, and it's one of the stocks that if the right price comes around, we will definitely invest in it. Steve, do you have anything to add?
Yeah, we also got asked the question here, when you keep saying more discipline, what does that actually mean? And I think, it is a regret of mine. I've talked about that business a lot over the past 10 years. And I honestly, if you said to me, one stock, you have to put your whole life savings into it and you can't go anywhere, that would be the business for me that I would own. But I think being really disciplined about what our role is for you, our investors, what we have an edge at, is really, really important. And I think the honest truth about that business is it's one of the biggest companies in the world. It's covered by 1 million analysts. It is a great business. It's currently trading at a very reasonable multiple, but our job is to get out there and build you a portfolio of things that you can't get in an index fund that are going to outperform meaningfully over time. And I think really sticking in that circle of competence is going to be important. Meta, is an example of a stock that I think, again, we could have waited. It's a very different situation now in terms of how much pessimism there is about that business. And if Alphabet ever ends up trading at 10 times earnings like Meta is, then people should think, well, okay, there is a real contrarian play here, even though it's a giant large cap stock. But I think expect us to stick more to that mid-small cap space where we really do think we either have some informational edge or where the market reaction to something has been massively overcooked.
We've just got a couple of minutes. That would have been a nice place to end, but I'm going to push it a little longer. From Tim saying, do you think that the ongoing market volatility has the potential to shake out some of the retail money from markets over the next few years, really resulting in a richer opportunity set for you all at Forager and your investors?
Well, you heard Steve talk about some of the high levels of involvement from retail investors in some of these businesses, and it has permeated parts of the market. Companies were able to get capital that may not have been able to get capital before, trading on loftier multiples than they would have previously. Some of that has already come out. Potentially more of that comes out, but it feels like the environment there has normalized somewhat, at least.
Also, I put something on Twitter the other day about Bitcoin and cryptocurrencies in general. People talk about them like a Ponzi scheme, but with a Ponzi scheme, you've got a bunch of people that have invested in something that think it has a specific value that they're being lied to about, right? It doesn't actually, that the assets are just not there. And when they go to collect their assets that they think are there, everyone is shocked and they just want to get back whatever they can from it. That's not what's happening here. Everyone knows that the intrinsic value of those cryptocurrencies is zero, that they don't have a worth. They're gambling on where the price is going to go. So I don't know that needs to collapse the same way a Ponzi scheme collapses. Sportsbet doesn't, people don't realize they're losing money gambling on horses and stop. They just keep doing it weekend after weekend. So I do think there is an element of what's happening in the gambling nature of the retail there that is more like people betting on horse races than it is, I'm actually buying a business here and I want to earn a return from it. So it could very well be it's going to come and go in terms of its magnitude, but I think you just look at the ads and the way people are marketing it, I think the gambling aspect of financial markets is going to be bigger than it was when people didn't have the same access they have now.
Yeah. Well, listen, we are out of time. However, I do know that you're willing to answer some of the questions that have still remained unanswered via email. Thank you. Yes, Steve, that's correct?
Yeah, absolutely.
Yeah, good. Okay, well, Alex, Chloe, Steve, thank you so much. That concludes the 2022 Forager Funds Roadshow. It's been a pleasure to have you all with us and to join us online, and we look forward to speaking more in the future.
You're watching the 2022 Forager Investor Roadshow.